A very good evening, friends. We welcome you all to this day two of this webinar series on the commonly found errors or the non-compliances with respect to Ind AS and the Companies Act. We had, I would say, very intriguing session yesterday with our esteemed panelists, Himanshu Bhai Kishnadwala, Anand Bhai Banka, and Santosh Bhai Malar, who would be joining shortly. And we have got a very good response, I would say, over the last evening with respect to the webinar, the concept, the questions, and definitely, last but not the least, the responses of the participants, which or responses of the panelists, which gave a lot of clarity. And in fact, that has resulted into more questions coming on the related topics. So to kickstart the day two, I would straight away jump into the question for Himanshu Bhai. And Himanshu Bhai, a very, I would say, simple but relevant question with respect to the normally what we used to do earlier is we used to have carry this note that about the sorry, previous year's figures being regrouped or reclassified. That which
Correct.
was a very common practice under the AS. But can you throw some light on the same with respect to Ind AS? Because I would say at FRRB, we find a lot of this regrouping, reclassification with the note without disclosure. So if you can just throw some light on that, sir.
Yeah, so good evening, all of you. And the question on this particular regrouping, reclassification, I think it is a very common thing where a lot of people say that they say where it is said that previous year's figures have been regrouped, reclassified as necessary. This is very common, especially it was there right from maybe last several years, which is there. And the idea was that in case there is some necessity based on current year's classification to change something, that classification will be changed accordingly. However, when it comes to Ind AS, in Ind AS, there is a particular paragraph which says then entity shall retain the presentation and classification of items in the financial statements from one period to the next. So it means that you have to keep it same unless it is apparent that following a significant change in the nature of your operations or review of the statements that another presentation is more appropriate having regard to the criteria of the accounting policy selections. So Ind AS 1 does permit this change of classification. However, that change of classification has to be supported that it is an appropriate thing. And there is also a correlated requirement in this Ind AS 8, where it says that in case you are doing a change of a classification, you will have to explain if the change is a material change in that sense. So if you are following Ind AS financial statements methodology, this note cannot be given unless you are really having a material change. And in case you are giving a note, you'll have to explain what are the changes. So this note typically in Ind AS financial statements cannot be there that previous year's figures are regrouped, reclassified wherever necessary.
Himanshu bhai, just further clarification. So, does that mean that any regrouping or typically the reclassification that would not be permitted? One. Second, if it is there, if it is required to be done, then would it invite a third balance sheet or giving a disclosure with respect to the current year, previous year regroupings would be sufficient compliance?
So if it is not material, if you are just doing it maybe for some business requirement, then it is just a disclosure which is required. But if it is material, it would even result into a third balance sheet.
Right. So I think that is a
But the standard routine way in which that note appears is something which cannot be given because that's a standard note which most of the companies give in a very routine way.
True.
So, Chairman, by the time you move to the new cabin, let me ask one question to Anand Bhai, if you permit me. Thank you so much. So, Anand Bhai, very interesting one. I think Himanshu Bhai, even you will agree to one fact that lot of companies which are actually yesterday also we had a small quick discussion and talked about one particular aspect of the new companies which are getting into IPOs where they were small and the turnover criteria was not meeting and now they need to go. So what is happening is more and more such companies. Anand Bhai is actually getting into the new reporting framework which is Ind AS. So in case of first time adoption of many companies, one is basically what is the statutory norm. Number two is basically if I'm doing it self compliance based. So what are the disclosure requirements? What are the general issues which are coming up for people? If you can just take up and give a little elaborated answer so that people who are watching us, who are moving away from the AS to Ind AS will have, and Himanshu Bhai might be once Anand Bhai does it, might be you can add with your points also in that
Fine,
specific question, right? So
fine.
Anand Bhai, over to you.
Thank you. Thank you so much. And yes, once again, I would like to welcome all and thank you for having me here today as well. So, to your specific question, firstly, Ind AS is applicable today to any company which has a net worth about 250 crores. That the net worth is computed as per accounting standards, as per the last audited financial statements. So, if suppose as an example, by March 2023 audited financials, if the net worth is about 250 crores, then for the current year, which is 23-24, Ind AS is applicable. Or if a company is in process of getting listed or is listed, then also Ind AS is applicable. So if a company is applying for listing, is in process of listing, then also Ind AS is applicable. Other than that, if you are a subsidiary of a listed company, then also Ind AS is applicable. So there is a good, well explained requirement list to which Ind AS is applicable, but I've explained the most common ones. Now, what happens when you first time move to Ind AS? When you first time move to Ind AS, you have to prepare 3 balance sheets. The first one, continuing my current example, if it is applicable for the first time in the year 23-24, then you will have a balance sheet of 24. You will have a comparative balance sheet of March 23. And then you will have an opening balance sheet of March 22. We call it 1st April 22 because that's an opening balance sheet, not the closing balance sheet. So we call it 1st April 22. Now that balance sheet is also called as the transition date balance sheet because you're actually transitioning on that date. Okay, so date of transition or opening balance sheet will be 1st April 22. Now the idea is that the full year March 23 and the full year March 24 is comparable. To make them comparable, all the adjustments that is required to transition from your old GAAP, which is accounting standards, to Ind AS, all those adjustments are made in the opening balance sheet itself, which is 1st April 22. So once you have made all these adjustments, that means all your assets, liabilities, everything is restated as per Ind AS. Whether you call it measurement restatement, classification restatement, all those restatements are done on 1st April 22. Then your P&L of 22-23 automatically falls in line with Ind AS because your depreciation, your interest on liabilities, everything accordingly will come in 22-23. So that restatement automatically happens. And the current year definitely will have to be under Ind AS. So that is how, you'll have to prepare 3 balance sheets, 2 P&L, okay, 2 cash flows. Then you have statement of changes in equity, which is also 2. So everything else is 2, but balance sheet is 3. Your starting point plus 2 years complete balance sheet period. Now, if I come to disclosures, for a person, a stakeholder, a reader to understand that balance sheet, what has happened between accounting standards and Ind AS, it is critical to explain the opening balance sheet. Okay, so whether there are certain exemptions and exceptions which is given by Ind AS 101, and Ind AS 101 is a unique standard because it only talks about transition. Once you have transitioned to Ind AS, Ind AS 101 is not applicable. So it is only one-time application. Now, how those exemptions and exceptions which are given by Ind AS 101, how have you applied them? Which ones you have applied, which ones you have not applied? Because some of them are optional. So whether you applied those optional ones or not applied, what have been the effect of applying those optional ones? Those things you'll have to give. So basically what we do is we prepare a reconciliation. Okay. So for 1st April 22, we present what were the numbers as per accounting standards, what are the adjustments with notes for each adjustment explaining each of the numbers which you have adjusted, and the new numbers as per Ind AS. This reconciliation you have to give for 2 balance sheets. In our example, it will be given for opening balance sheet, which is 1st April 22, and the comparative balance sheet, which is March 23. Because both of them you have presented in accounting standards earlier. So now you'll have to give a walk from accounting standards to Ind AS for both these balance sheets. A similar reconciliation will also have to be done for P&L of the comparative year, which is 22-23. For that P&L also, you'll have to give a complete walk. What was the P&L as per AS and what is the P&L as per Ind AS line by line. Now, one more point I like to highlight is sometimes during this transition, people come across errors. For example, warranty provisions or provision for doubtful debts, bad debts. A lot of errors come across when you go through this detailed transition. It is mandatory to give out disclosures for these errors. You cannot just simply term it as Ind AS adjustments. If these are errors, you will have to call it as errors and you will have to give disclosures for these errors. So back to you, sir, or Himanshu bhai, if you have anything to add on to this.
No, Anand very nicely explained the transition in a very brief manner. So, frankly, it's a process to be done, and there are a lot of disclosures which come in, especially in the reconciliations for both the asset liabilities and the profit and loss items which are there. Now, once having done so, if I go back to the earlier question which was there, having done that, now if you try to reclassify anything, say from trade payables to current liabilities, or maybe try and net off some things which is otherwise permitted by the standard, you will have to go back to the earliest year and do that also in that particular year which is restated. So that is even post the Ind AS acquisition, that if you try and restate anything and it's a material amount, you will have to go back and restate all the balance sheets which are there in that sense. Now that is what is coming from that very first question, that simple note which you write all previous years figures are restated, reclassified, is not something which can be given in any case in an Ind AS financial statement, because it can have a lot of ramifications if there are really such adjustments which are carried out.
Very true. And therefore, with 3 balance sheets, 2 P&L, we like you mentioned, I think so. An important aspect is also to give the reconciliation of the adjustments, because the FRRB findings on specifically relating to Ind AS 101, that the reconciliation of the IGAAP, Indian GAAP versus the Ind AS, or I would say AS versus Ind AS, was not given in a couple of cases, and in some cases it was also observed that the note on transition to Ind AS, or even I would say the opening balance sheet was missing, and therefore these are important compliances which have been rightly shared by Anand bhai and Himanshu bhai. Himanshu bhai, continuing with I would say transition, there is like you mentioned that this regrouping, reclassification, all those things, we have to digest that it would no longer be applicable. Similarly, there is a requirement of giving a explicit and unreserved statement in the financial statements regarding compliance with the Ind AS. So is this applicable only in case of transition or every year? And second thing is, what should the disclosures be made relating to amendments that are notified but not yet made effective as at the balance sheet date?
So both these things again are as per Ind AS 1 itself, the basic presentation standard. And what is required is that whenever you prepare India's financial
Yep.
statement, you need to say that you have followed everything in totality and there is nothing which is missed out in the India's thing which is there. So you need to clearly give that unqualified reservation that you have followed India's as applicable. And you cannot say that I will be selective, even in a very, very small thing also, you cannot be selective, whether that is disclosure, measurement, nothing is possible once you are following this Ind AS. So that somewhere in your financial statement, you'll have to say that these financial statements are as per the Ind AS requirements, and which typically companies write that all financial statements are prepared as per the notified standards under section 133 and so on. Typically, that is a disclosure which comes right in the beginning of the financial statement by most companies. What was the second thing, Vishal, you asked?
Himanshu, it is about the standards which are notified
Okay.
but not
Yeah.
made effective.
Sorry. So that is again a Ind AS 1 requirement that in case on the date of your adoption of your financial statements, there are some standards which have been notified, but which are not yet applicable to the period under reporting. You will have to bring out a list of it. Just bringing a list is not enough. What the standard says is, in case that standard is likely to have a material impact on your subsequent reporting, that also has to be brought out. So like in this particular year, 23-24, there is no new standard which has been notified. However, in the last year, on somewhere on 27 March 23, the ministry had notified about 8 or 9 standards. The major ones were changes in Ind AS 1, Ind AS 8, Ind AS 12. These were the 3 major ones, plus about 5 other standards where there were changes. So as per Ind AS 1, there was the disclosure required that the MCA has carried out these changes in the standard, and the standards are not applicable for March 23, but applicable from 1st April 23. Most companies gave the disclosure, but they stopped at that. They should have also said that, is there a possible impact of those standards on the financial statements? And again, companies who were forward looking said that the company is in the process of evaluating whether these changes will have an impact going forward. At least that is a good enough statement rather than ignoring it totally in that sense. For March 24, now March 23 is gone. Those 8 changes, whoever has done, they have done it right. Whoever has not done, they will regret. They cannot do anything about it now. But when it comes to March 24, there are no new standards which have been notified by MCA. However, a paragraph is still required that the ministry for this year has not notified any new standards. And that is better to give such a note, because otherwise on a continuity basis, you may again lose out giving the note in the next year when again some changes have come about or something. So this year, even the 1 or 2 published results which have come, they have included that note. In this year, there are no changes which have been notified by the MCA, though last year there were about 7 or 8 changes which had come.
So I think so, Himanshu bhai, well covered, because these are some very minor things which may look from the face of it, but like you yesterday mentioned that Ind AS 1, it's one of the maybe least read or least referred to standard, but a majority of the non-compliances, if I look from the FRRB perspective also, are coming or emanating more from the non-compliance of Ind AS 1. Good evening, Santosh ji. Welcome, sir.
Very good evening.
Thank you for joining.
Meanwhile, if I may add something to the last point which we were discussing.
Yes.
Some of the balance sheets which I have seen, there is one more requirement which generally people have not done it, is also about changes which are applied in the current year. So, like Himanshu bhai was talking, there are 8 changes which were notified on 27th March 2023, which were applicable for the current year. So, requirement for March 23, like he rightly said, was to give whether these will have any material effect when you apply it or not, or you are in the process of assessing the impact of it. Both of them are equally good. But in the current year also, you have a requirement to give that these are the changes which you have implemented in the current year, which were those 8 ones, and whether those have in the current year have had any significant impact or not. So you have to give two disclosures. One, what are the standards newly implemented in the current year? And second is standards which are not yet effective in the current year will become effective in the future years. So both the disclosures are equally important.
Great. I think a good amount of deliberation, but I'll just put it in a different manner, Anand bhai, because you were excited to answer and add what Himanshu bhai said. तो 2 रन तो आप ऐसे ही ले लिए थे, तो भाग कर. तो अब आपके लिए one more question is generally, a word generally is being used generally in the financial statement. So generally you should use the word generally or you should not be using the word generally is something which generally we people would like to understand from you. Should the companies use the word generally in significant accounting policies? So that is the question.
No, so the problem in using such terms generally is that what happens when it is not general? Is there an exceptional scenario? What is that exceptional scenario, and what happens in those exceptional scenarios? Those are important to understand. So companies who first of all should not use the word generally. If you use the word generally, then you should also give what happens if it is not that general situation. Are there any exceptional situations? And what happens in those exceptional situations? So that would be my response to this.
हिमांशु भाई, आपकी स्माइल रोको मत, अब लफ्जों में बयान कर दो.
No, this generally is not something we can use it, though people use it very often. So this word significant, general, which do not really carry any sense, no, it is not something which could be carried in the financial statement. It's good in discussions and all, but you have to finally now look at only materiality. Even that significant is not something very relevant now. You have to just look at what is material and what is not material. You can have, say, some reclassification done of items from current year to last year, which may not be material. Then you may not like to go and disclose too many things about it in that sense.
Right. No, generally you should not be using generally. That is understood very clear, but I think that is the right way of putting it forward. And generally and significantly, though it has now been replaced with a word called materiality. So materially you should be actually concerned about rather than being generally concerned about.
Correct.
Just to follow with one more question, which is very interesting, Anand bhai, to you back again. So the point is, please throw some light on common control transactions. And it was noted in case of company that business combination arising from transfer of interest in entities under common control are accounted at historical cost, and the difference between consideration and historical carrying amount of asset and liability of the interest acquired or disposed are recorded at retained earnings. So it is on the business combination part. And I also have very interesting point which I need to discuss. But let us first conclude on this particular point. You want me to repeat it? Or you
No, I'm clear. So very interesting. Firstly, I would like to tell you that common control business combination guidance, which is part of Ind AS 103 Appendix C, this is only in Ind AS. IFRS generally scopes out the common control transaction out of IFRS 3. So there are varied guidances available under IFRS, but under Ind AS there is specific guidance given by the ICI. So that is one. Secondly, because there is specific guidance, you'll have to follow that specific guidance. And these terms which have been used, in the example which you gave, which is, historical cost, and the difference is recorded in retained earnings. These are very loosely used terms, which is not allowed and which is not correct also. The word used by the standard is you have to follow pooling of interest method, wherein you use the carrying value and not the historical cost, because historical cost is different and carrying value is different. You depreciate the historical cost and come up to carrying value. So carrying value under the pooling of interest method is pooled in, and the difference between the consideration and the carrying amount of assets and liabilities, and not the historical carrying amounts, the current carrying amount of assets and liabilities. The difference is taken to actually capital reserve. That is also not taken to retained earnings. So you pull in assets, liabilities, reserves, all the three things you first pull in, and then you compare the difference, and that difference goes to capital reserve. So the words which have been used here are not correct. So people should be little more cognizant or appreciative of the terms used in the standard. They should not be using loose terms, because that will give out a different meaning to the readers of financial statements. Back to you.
Also, yeah. So also, Anand, I think if you, Himanshu bhai and Santosh, three of you can actually define what common control is, because there has been a recent issue. 3 days back, I was sitting in my office, and there came a client who wanted an opinion with regards to common control. Now, the common control concept is 20% criteria, which is one of the important one, right? And the second side is there are certain recitals in the agreement wherever the investment was being made by the company, right? In that very clear conditions were being put, where without their consideration XYZ, so many things cannot be done, right? But the control is less than 20%. So the common control, when we talk about, I'm just deviating, Vishal bhai, only because this is something very interesting which came to our table discussion, because three different firms, they gave three different opinions, right? Or even the large firms had a different thought process on that. After reading the agreement, what is there? Example, I can control the board. Without me, the board cannot function. Whenever the important decisions are to be taken, both the parties actually have to sit together and take decision. If the new appointment has to happen, that has to happen. But the criteria is they are holding 18.9% or something like that. So whether it comes under common control or it doesn't come under common control. So that was the question for all three of you, or if one gives and you all agree, I think that's more than enough, right?
So maybe if I can start with, so firstly, this common control is very, very debatable, because it's only in India. Like I said, it's not there internationally. There is, varied accounting done internationally. In India also, currently the Accounting Standards Board is, having a relook at the guidance, whether it is correct, whether there needs a change or not. So it's fairly debatable area today. Secondly, control, the definition of control is either you have to fulfill the 50% criteria, so not 20%. So you have to have 50% or more, first criteria, or any of the two. The second criteria is you have control over, so there are pillars which are given, okay? The three pillars largely, the way the definition works, okay? One is power over the investee. Now, power is little bit different from control. It's not exactly control, but control comes within that power scenario. So you should have power over the investee. Second, your decisions which you make, the decisions which is made by the board affects you. The returns which you generate from those decisions get affected. So you are affected. So if you're holding those many shares, or that percentage holding is there, only then you will get affected by the returns of the investee. And third is you are able to take decisions. You are able mind, you have decision making power, you have capacity to take decisions. So one, you should have power. Second, you should you should be affected by the returns of that investee. And third, you should be able to use the power to affect the return. So these are the three large pillars which is there in the control definition. And because this is principle based and subjective, hence the agreement which you referred to, we have to refer to the terms and conditions of the shareholder agreement, which has been signed between the company and the shareholders. That is very critical. Who holds the power to make decisions? So if you have more than 50%, okay, but if the other party controls the board of directors and the decision making, if we go back to accounting standards, probably both the parties would have consolidated. But under Ind AS, only one party will consolidate, and that will not be the party holding more than 50%, but it will be the party who is actually controlling the board of directors. So that is where you're completely swinging or changing from a purely objective criteria, which is in form you are holding more than 50%, to a substance-based criteria, which is who is actually controlling the decision making of the company, who is actually getting affected by those decisions and the ability to take those decisions. And so that's the control definition first. Secondly, common control means if two companies are getting controlled by a single person, that person can be individual, that person can be entity, company, a legal form. So that one single party, one single person is controlling two or more companies. Then those two or more companies are under common control. So first you have to establish control, then you have to establish both parties are under the controlling of same person, same individual. Now, sometimes people ask that if there are two brothers, family members, husband, wife, who are together controlling. So together is not allowed unless one party gives power of attorney or something, some agreement is there in a way that one party takes decision on the behalf of the family. Then it's a different issue, but otherwise, family holding or husband-wife holding, brother holdings are not allowed to be seen when you consider common control. Over to you, Himanshu Bhai or Santosh, if you have to add anything on.
No, I will just like to add that lot of these pointers on whether control is there or not actually come from Ind AS 110, because that clearly decides when to consolidate, not to consolidate. So a lot of these pointers will come from there. And again, when someone is debating whether it's a common control acquisition or not, the focus is not really on accounting. The focus is really on the tax issues, if you look at it practically. Because the major difference is that if it is a common control, you will go by what are the book values, as it is commonly called, though it is a pooling of interest, but I look at what are the book values in my financial statements rather than doing a PPA or something of all the assets acquired or something. So a lot of companies would prefer to go with this common control, the Appendix C of Ind AS 103. But as rightly said, the control definition has to be read in detail, looking to even the guidance given in that 110. Coincidentally, internationally also they are coming up with a new standard or amendment to that 103, which says business combinations under common control, BCUCC as they call it. And they are coming out with a much more structured approach to how this combinations under common control will be there. I believe the standard should be out by the year end or something. Lot of drafts and discussions are already happening on that particular standard. So Santosh, if you want to add something.
No, I fully agree with what Himanshu sir and Anand mentioned. Just to add one more point is, as rightly said, the definition of control, Dayanimazji, has to be read in context of Ind AS 110. And if you look at the concept of control under Ind AS, it's a lot more wider than merely majority voting shares or majority, ability to control majority of the directors, board of directors, because there are concepts like de facto control. There are concepts like potential voting rights. So all those things also need to be considered while you assess control in the context of common control for that Appendix C to Ind AS 103. And by the way, please accept my apologies for being late. And I seem to also have some patchy internet connection today. So,
yeah, maaf kiya.
No worries, sir. सर इसलिए अभी आपको थोड़े 2-3 सवाल पूछ लेते हैं संतोष भाई, so that you can we catch up with the others and others can take a bit of a break.
Yeah.
So it's on a tricky issue, and I would say a sensitive issue with respect to related party disclosures. As we know, all the regulators and everybody is very much concerned about the related party disclosure. So one is with respect to the compensation that is paid to the KMP. So are there any categories under which the compensation should be paid to the KMP should be disclosed? So you can respond to that, and then I'll ask the follow-up question on that.
Sure. No, the answer to that is correct. Yes, there are categories. So in fact, both Ind AS 24 and even the AS 18 requires certain categories within the broader compensation to be disclosed, the segregation of that. So short-term benefits, whatever short-term benefit have been given to the KMPs, whatever let's say in certain cases there can be share stock options, ESOPs, etc. given to KMPs, that also needs to be disclosed. Any defined benefit obligation, benefit that is given to the KMPs, that also needs to be disclosed. Of course, practically many a times we come across some practical difficulty because many a times actuarial valuers measure the defined benefit or gratuity actuarial valuation on an overall basis, and it's sometimes difficult to segregate usme se what is the portion that is allocable to the KMPs as such. But as a requirement, one needs to make that attempt to get that segregation. And any other kind of compensation, any apart from this, there are so that componentization of the disclosure needs to be provided towards compensation towards KMPs.
Right. So continuing with the KMP disclosure, Santosh bhai, should companies disclose KMP of parent company as a related party? And also, is the disclosure required of the KMP of parent company as a related party, even if there are no transactions with them?
So that's a good question, Vishal bhai. In the context of Indian companies, many a times we see that companies, there are holding companies, there are subsidiary companies, the directors, many a times promoter directors of the holding company also have a significant authority in the subsidiary company's management. KMP is any person who has the right to drive the major decisions of an entity is defined as KMP, and therefore it is a very broad definition. You cannot hard code it to just the directors of the legal entity. It can be also the holding companies KMP who can exercise their rights and influence on the affairs of the subsidiary companies. So therefore, to answer your question, yes, in the context of the circumstances of a company, if there are any holding companies KMP who exert their influence on the affairs of the company, of the subsidiary company, they would qualify as KMPs for the purpose of the subsidiary company's disclosures also. One needs to be mindful that Companies Act also has its own definition of KMPs, and so therefore one has to keep that in mind also. The second part of the question is, if there are no transactions with the KMPs of the parent company, then would the subsidiaries' financial statements need to have identify them as related parties? Ideally not. So there is an exception in Ind AS 24 that unless it's a subsidiary holding kind of a related party, a relation, you don't have to disclose the related party transactions. If there are you don't have to give the names of the related parties if during the current year you don't have any transactions with that related party. So in the overall universe of related parties, you need to capture the KMPs of the holding company. But if there are no transactions of the with the KMPs of the holding company, then ideally you don't need to necessarily give those disclosures in the subsidiaries' financial statements.
Yeah, thank you, Santosh bhai. So now we would have another round of question. Again, like yesterday we discussed about the material accounting policies. On a similar note, because this has come from the participant also, and I would request Himanshu bhai to start with it with respect to NOCLAR. And its applicability, because it would be applicable to the preparers also. And since we are having a large number of preparers of financial statements, maybe Himanshu bhai, you can first throw some insight on with respect to the NOCLAR.
This is no clear as per the code of ethics which we are talking about.
Right, right.
पर हमारा बंद कर दो।
Because the auditors would also need to report on that.
So this is a very typical requirement, non-compliance with laws and regulations. So in case the auditor in the course of his, obviously this no clear requirement applies only to the auditors. It doesn't apply to the preparers in that sense, because this ethics, code of ethics, which has come about, brought this concept of no clear only applies to the members of the institute and the members who report on the financial statements. So in case the auditor in the course of his audit finds that there are some significant violations to the laws and regulations of the particular country which or the company which it has to otherwise comply with, it has to first bring it to the notice of the audit committee. Obviously, before that, the management, the audit committee, and if it is a serious one, it has also to be informed to the concerned regulators in that sense. So at least I have not come across instance where there is a reporting done to the regulators directly on a no clear thing. But there have been several cases where the audit committee and the management has been brought to notice that there are these non-compliances which have been noticed. Some simple ones could be like, say, your FEMA requirements. In FEMA, if you have an investment in a subsidiary, if you are having a lot of export proceeds, FEMA does require you to comply with things that if your export proceeds are not in time, you do need to do formalities. If you have multiple subsidiaries, you need to file several forms which are ODI or your APR and other things. And a lot of companies may not have done that because they have not got any notice from the authorized dealer or from Reserve Bank in that sense. But NoClear would require that auditor to inform that to the management and the audit committee, those charged with governance, that this is a significant or maybe this is a material non-compliance with some of the applicable laws and regulations. There are some things which are directly reported in, say, CARO, like, say, whether the NBFC compliances need to be done or not done by a particular company. But NoClear does not mean that simple things like, say, some say traffic violations which are noticed, they also need to be reported. It really talks about something which is material, which can impact the functioning of the company going forward. Say a pollution related thing, the auditor knows that you have violated the pollution norms. There is no notice which has received. It would be your duty under this NoClear provisions to bring it to the notice of those charged with governance. And if nothing is done, nothing is really done, theoretically at least, you also need to inform the concerned regulators that this is something which has not been done.
So, just a thought that with respect to the normal provisions or the contingent liabilities also which are disclosed, because there would be a tax demand, let us on the fiscal laws I'm saying. So would that, because there is a violation of some provisions of the, let us say, Income Tax Act, disallowances have been done, and there is a demand which the company pays up, would that also come under NoClear?
It would not come under NoClear because in a NoClear, what would be covered in my view is only where the regulators have not noticed or issued any letter to the company concerned, to your auditing. In the case of contingent liabilities, they have already got a demand, they have already got a show cause notice or something. NoClear really means that something which is not noticed by any regulator, but you notice it as an auditor in the course of your audit process, which is there.
Fine. So, Santoshji, would you like to add anything to that?
No, I totally agree with Himanshu sir. So I think in income tax, in the context of income tax laws, what would perhaps come under NoClear would be, let's say, if there is any unreported revenue. Of course, now under CARO, we have to report specifically on unreported or underreported revenue also. But let's say if there is any cash transaction, for example, I'm just making up a hypothetical example, and that is, evasion of tax, which the auditor comes to, comes to know during the course of the audit. So ideally, apart from the reporting requirements in the auditor's report, now I will have to report to the income tax authorities that this is something which I came to know during the course of the audit with respect to this company. That is my sense. Yeah.
Anand bhai,
No, sir, I think it is very well covered by Himanshu Bhai and Santosh, so nothing to add.
Good. So the next question again for Santosh bhai, because एक run लिया but वापस boundary पे से again the batsman is same. So Santosh, for you another question which is very interesting from Ind AS 107, which is on the financial instruments disclosures. This is with regards to the cases where the default in repayment of loan. It is necessary to disclose the details of default, or it would be sufficient compliance if it is mentioned that the default has been remedified before the approval date of the financial statements. That means you got it right. Before the financial statements, if it is complied, then I need not report. But if it is not, the disclosure is required. So what is your take on that?
Yeah, so Dayanivasji, see, in that case, Ind AS 107 specifically requires both the defaults that have occurred during the course of the financial year, and also, let's say, if there are any remediation by the company. So, for example, let's say if there is a debt covenant which a company is required to follow as a part of a bank loan agreement requirements. And let's say if there is a default in some of the covenants that are required or prescribed under that loan agreement during the year, and during the course of the year, or even subsequent to the balance sheet date and the signing date, there is basically a remediation by the company, or let's say if there is a waiver by the bank that this has been rectified, this has been remediated. So in that case also, you need to disclose both the fact that the default has happened as well as the fact that that has been subsequently remediated by the company. And under even, in fact, the CARO requirements, and Schedule 3 requirements, you need to have a reporting of this particular default. Now we know that under CARO 2020, there are certain additional reporting requirements. Default in repayment, etc., is also one of the requirements that one needs to make as an auditor.
yeah, I think so that answers it. Himanshu bhai, question. So like I mentioned, we received questions from the audience yesterday. So this question is from Puneet Nathwani, Rajkot. Whether accounting policy on impairment needs to be mentioned in the financial statements every year.
So again, this is again trying to find out the difference between significant and material. So if till last year, since impairment was always a significant policy, it was always mentioned. An impairment is in two counts. One is of financial assets and the other is on non-financial assets. Now this year, because of the amendment to Ind AS 1, you have to first of all decide whether that impairment policy remains a significant policy for you, or does it not remain a significant policy. Now, in case you believe that anyway, testing of impairment always needs to be done. Now, having tested for impairment every year, if you believe that there is a possibility of a material impairment which will happen, at least in that year, you will have to write your impairment policy. Otherwise, just a simple mention along with the relevant financial asset and the non-financial asset recognition. If you say impairment testing is also carried out as required by the applicable standards, that should be good enough. But whenever in a year when you have a material impairment, then the whole details of the policy will need to be mentioned because of this change which is coming in now. But again, this needs to be tested in practice. How many companies are willing to take that stand and give only a single line now and then give a detail only in the year of actual impairment happening.
True.
No, yeah, if I may just add here, of course, I agree with what Himanshu sir just mentioned. But let's say in case of, say, a company having significant goodwill balance, goodwill as a requirement, the company needs to test it for impairment on an annual basis, irrespective of whether or not there are impairment indicators. So if a company has significant goodwill balance, for example, and let's say even if in a year I don't have a impairment, so in that case, in my view, you would still have to give the disclosure for the accounting policy disclosure for goodwill, testing the goodwill for impairment, because you're supposed to carry out that exercise annually. So
Right. Anand bhai, the next question to you, and maybe because of the name also, I'm asking a bit early. It's from Jay Shah, Ahmedabad. So the question is, interest paid on account of delay in payment of tax liabilities, how should it be presented in the financial statement? So typically the question, as you would know, whether, yeah, so over to you, Anand bhai.
Again, a very interesting question, sir. And there are two parts to it. One is the P&L part and one is the cash flow part. So first is P&L. Now, because the question, as you said, says that it's a delay in payment, which is time value of money. Okay. Hence, it should ideally be taken as part of finance cost, even though it is on tax. But if, the interest or penalty is in the nature of penal nature, not in the nature of time value of money, and not, just because of delay. So one will have to assess whether it is a time value of money or it is penal in nature. If it is time value of money, it should go to finance cost. If it is penal in nature, it should be added to tax expense. Now, coming to cash flow statement, in cash flow statement, anything which is classified as finance cost, coming from P&L, I'm just carry forwarding the discussion. If in P&L you have classified it as finance cost, then under Ind AS, it should go as cash flow from financing activities. And if in P&L you have classified it as tax expense, then it should go as tax paid under cash flow from operating activities. Now, under Ind AS, for interest, you don't have, option. If I consider IFRS, I could have possibly classified interest of such nature under operating activities also, because, it gives me flexibility to classify interest as operating or financing. Whereas under Ind AS, that flexibility is not there. Under Ind AS, it is mandatory to classify all interest as financing. So if this has gone as finance cost, it will go as financing activity.
So Anand bhai, just for further clarification, typically the way we have the tax laws in India, that at the time of filing the return, there might be a 234 ABC interest. And I'm just looking at very broad thing. And there might be interest which are paid, on subsequent assessment orders being received. So whether it would be construed as a penal interest, or how would you look at it, considering the Indian situation in the Indian tax laws, and how it should be disclosed?
So my view would be 234 ABC, where you have a fixed rate of interest applied based on number of months you have not paid tax. That is akin to time value of money, which is like finance cost. So this is not penal in nature. This is largely time value of money. That is how my view would be.
Fine. So I think so that would, yeah.
No, just to kind of, that answers my question, Vishal bhai and Dayanivas ji, why you chose cricket as a theme for the questioning, because now I realize the secretary of BCCI is also attending this webcast, so it's happening to me.
Nice one.
Nice one to give back.
Yeah. So Santosh bhai, the audience question to you. whether government grant is a financial asset or not?
So it depends on the nature and what stage it is at. So Ind AS 32 and Ind AS 109 scope out any. So what is a financial asset? It is something which is contractually, whatever is you're entitled to contractually. The main word there is contractually. Government grant is generally a right which a company has as a public policy, as a kind of a government policy as such. So therefore, generally, government grant is not it's scoped out of the scope of the financial instrument standard 32 and 109. But having said that, let's say if you have government receivables, so if you have accrued the income under the government grant standard, and if you have government receivables, either by under some scheme, and if you have therefore a right, a receivable from a government under the scheme, at that point it becomes a financial asset, and therefore you have to also subject it to ECL, time value of money, so on and so forth. So it depends on what stage it is at that you're looking at.
Thank you, Sanjay bhai. I think well covered. But वो क्या है ना, जब से आप इतना बोलते बोलते, I'm just saying that there is a lion who is sitting hungry for question, no other person than Himanshu bhai. So let me just throw one question to Himanshu bhai. अब cricket से थोड़ा जंगल की तरफ चलते हैं, because the financial matters are little tricky, and more importantly, the fact is words. How do we play around is something which is very critical, Himanshu bhai. And one such area which we have noted in FRRB was with regards to the policy of inventories, policy for inventories, where, very simple but very important, very simple but very important. Words like cost or market value, whichever is lower. Lower of cost or market value. Lower of cost and fair value, which is the correct wording as per the standard. As simple as that. So this word play which is happening, somewhere we need to understand that certain names or the nomenclature, the way it has been put, we cannot tweak around with that. Correct? So अब इसके point of view से, just can you enlighten our members on these three criteria: cost or market value, whichever is lower, lower of cost or market value, lower of cost and fair value.
Okay, now this is a very basic thing, and I think a lot of companies, a lot of auditors try to use these terms, maybe as they call it, they juxtapose each of these phrases, these words, because everyone typically loosely understand that I have to compare cost, I have to compare market value, whichever is the lower, I have to take. That's a general understanding of this valuation thing. However, when it comes to putting down a proper policy, I will have to look at what Ind AS 2 says. And Ind AS 2 clearly says they have to be measured at lower of cost and net realizable value. These are the words of Ind AS 2, lower of cost and net realizable value. Now, why this phrase is used? Cost is defined in the standard. Net realizable value is defined in the standard. So net realizable value is sale price less cost to sell that product. Cost, there are multiple ways in which you work out the cost based on whether you are doing first in, first out, or a weighted average or something. So these are defined terms which are there. If you try to use anything else which is not defined in the standard, obviously you are not writing what you are doing. In most cases, companies follow the right thing, but they write the policy in a wrong way. So if I write cost or fair value, whichever is lower, it's wrong, because net realizable value is not equal to fair value. If I write net lower of cost and net selling price, again, that is not correct, because I have to write realizable value. If I do the other way around, cost or market value, whichever is lower, that is also not the right way to write. So, I mean, you have to write what is exactly required in that sense. And this is typically even in the examination, no? A student will actually not get any marks if he writes this phrase wrongly. He has to write the exact phrase. And I am sure in the exams, when you give this, what you say, this objective questions, this is one of the very favorite questions in your objective question, where you give this ABCD and the student has to select the right answer of these three, four things which are there. You have to be perfectly on the job, I mean, on the words in this particular case.
You actually touched both of us heart, chairman and vice chairman. Reason being, last year we were the chairman, vice chairman of board of studies, and before previous year, I was the chairman, he was the vice chairman. And the best part, let me put it this way, friends, the new curriculum which is going to have their exams in the month of May are going to come with 30% MCQs.
Correct.
If this is not been read in a right context, passing in life is later, passing CA examination itself will become difficult. So technically playing around with words, we think that we are intelligent, but the fact goes very simple. These are certain critical aspects which we need to understand very importantly, because when these small phrases are defined, the kind of debate goes through for the use of language. We have gone through it, at least particularly I have gone through when we were debating whether it should be forensic audit or forensic accounting. And this debate of accounting and audit, when we were designing the standards of forensic, Himanshu bhai, we took 8 hours to debate only whether it is accounting or it is audit. So when you talk about a net realizable value with an example which you gave, if we get an, I was teaching my daughter the other day in her 11th standard, opening stock plus closing stock minus what is so much and all those things. So those formulas actually cannot be changed for any practical purposes. Technically, when you talk about the fundamental things by using words, it becomes very important. Santosh bhai, you have been watching very seriously. Any comments from your side? I think you are बहुत serious सोच रहे. या तो आप कहीं तो भी लिखे होंगे net realizable value के बदले lower आपका.
The reason I'm serious is because Himanshu sir was my professor in 11th standard in NM College. So,
so you are remembering him as a professor, or you're remembering that answer went wrong?
But I have been very lucky
Great.
enough to have maybe students like Santosh then.
No, it is always good. It is always lucky for a student to have a good teacher and for a teacher to have a good student. And there is no better place on this planet Earth, let me tell you, friends, where a competition is created by another competitor for you in a true sense. This only can happen in Institute of Chartered Accountants of India, that these learned people are coming forward to share their experience pro bono without charging a single rupee, putting their time, energy, effort. Might be they are committed for multiple other things. But the most important is, in the interest of profession, Vishal bhai, I think all these people who are the faculties for the institute, I think a big round of applause for all those people who have been doing a great job. See, we are elected representatives. We can do so much. But beyond that, the universe actually stands with all you people. We are just one of the stars in the process. And really appreciate the kind of thought process. This is, I'm touching upon from a point of view of a student and a teacher. True. And the student and the teacher, just imagine the kind of experience with which we are talking. We are also having questions in our hand in form of paper, and we are talking to you so that it becomes very interesting for our members to understand what is important in a very simple format. Might be I was just talking to chairman, which he agreed. One webinar which we will do together is how to read a financial statements. When we are talking about different questions, let us take the financial statement from the beginning. उसकी balance sheet के अंदर क्या नाम आना है, कैसा उसका rupees, crores, value, date, information, this, that, because these are fundamental things which I think in the race of making it more good, we are losing the fundamentals somewhere. I hope you both, three of you agree, right?
Yes.
So I just wanted to add it. एज अ चेंज थोड़ा वो टीवी में आता ना, वो पिक्चर देखने के तो ब्रेक आता है, या मैच के टाइम पे है ना, थोड़ा सा एक चेंज के जैसा शाहरुख खान सलमान
Time
खान आ
out,
जाता
time out होता
है,
है ना।
टाइम आउट हो जाता है। तो हम दोनों आज थोड़ा डिस्कशन वो पॉइंट ऑफ व्यू से कर लिए सर। Long time that Anand Bhai has been actually waiting. He actually went off, then he came back. Now again he is there on the screen on the left of his side, right of his side. There is a glass. He's actually combed his hair and now again he's back before us. Am I right, Anand Bhai? There is a glass behind next to you, right?
Yeah, it's not a mirror though. It's a glass. So it's a small
Yeah, yeah.
cubicle. Only one person can fit into this cubicle. So
तो ये पनिशमेंट तुम्हारे ऑफिस का है, हमारा नहीं। हम तो चाहते हैं
cost
आप
saving, sir, cost saving.
Thank you. So, Anand bhai, a question to you with regards to Ind AS 105, which is non-current asset held for sale and discontinued operation. Again, a very important point, very important discussion which is coming when you read a lot of financial statement. The property values are going in a big way from one direction to the other direction. And a lot of companies are actually thinking that, let me just convert this into held for sale ke liye from non-current assets. So this question is primarily coming, if you see most of the financial statement, Vishal bhai, now the profitability from the operation is lower than the sale of assets sometime. Correct, Himanshu bhai?
Yes,
A lot of
correct.
companies are actually having that. So, what is whether Anand bhai, is it right when we talk about it was noted from notes to account that asset classified as held for sale, that land and building has been classified as asset held for sale, and profit arising out of the sale of such asset has been disclosed under other income. Is it in compliance of Ind AS 105?
So, sir, I'll give you answer in two parts. One is when can you classify it as held for sale? So, as per Ind AS 105, there are certain conditions. For example, the sale is expected within 12 months. You are actively looking for buyers. The price that you are quoting is reasonable. It's not too high for, so your intention is really to sell. That has to be established, and the sale is expected within next 12 months, and your asset is ready for sale. That means, you have kept it ready. You're not using it, or there will be certain things required before you can sell it. Then it's not held for sale. Second thing is, this assets held for sale is not a non-current asset. So normally a land and building would be non-current asset. But once you classify it as held for sale, it becomes current because your sale is expected within 12 months. So you are going to recover within 12 months. So you need to, reclassify that land and building as assets held for sale in the current assets. Now, when I come to this notes to accounts, you have to give out reasons and description as to what is the event, what is the transaction, what is the sale value, and then yes, finally profit. And then you can say that profit is disclosed under other income. So disclosure or presentation of profit under other income is fine, but there should be a descriptive note which explains the transaction, explains the event under which, why did you classify it as held for sale. Those events you need to explain in detail, along with what is the sale value. And I'm naturally assuming that the transaction is material, because for immateriality, nothing applies. But if it is material, then you have to disclose detailed notes. Just a line will not help.
One more interesting point that is very, very good part on the straight jacket question. Now, one instances which I have come across is when we were signing a balance sheet of a company which has gone under the IBC, right? And because the entire process was going so late, the plant machinery, the entire operations were actually hauled for a longer period of time. And the interesting part, I think you three can actually answer in your own way. There's a very practical aspect which I'm putting in. Now, when this entire company is gone for the IBC, they have got the valuation of the property done, right? The valuation of the property which has been done, the insolvency professional says that I cannot give you the valuation for doing impairment because this is going to be a bid price, right? I hope you are getting my point, right? Or you want me to repeat anytime I can repeat, because this is a very important part. A lot of insolvency processes happening and a lot of operations which have gone on stall, and there is a lot of reporting requirement. Trust me, it was so difficult for me to draft that point, I can't even imagine. So I'm just asking it a very practical part. This company, which was actually, which has gone into IBC, now that means the company is going under a sale process. Now, under a sale process, the challenge is the valuation which has been done by the insolvency professional is not being shared by the auditor. And now the problem is, what is that I need to disclose and how is that I need to disclose is something which is very important, right? And the best part is the moment I have closed the financial year, the next year, the 31st March is over. In the next year, after 2 months before the finalization of accounts, the transaction is closed. But the fact is, the transaction payment has happened only after the financial statements are being done. So there is a lot of complex scenarios which are coming in. But just to cut it short, what do I do in a circumstance with regards to these kind of assets which are held under insolvency process? Do I sell as an asset itself, whether that is not in the operations, discontinued operations, right? Or do I actually, how do I report?
So, okay,
थोड़ा
I'll
complex
go.
हो गया.
No, I'll go first.
ये यॉकर था सर, यॉकर था ये.
So, I mean, rightly so, when something is in the IBC process, things do become complicated because the first reason why it becomes complicated is the information is missing or the information is not fully available to you as the auditor. The IBC also sometimes selectively shares information, sometimes does not share the full information. And so in a case where you have got assets which are now put up for sale by the IRP, and you don't have information as to at what value you will record the assets. Typically, the value at which you will record the assets when held for sale are again cost or what is the realizable price of that asset when I finally get the price for it. There's nothing like an impairment in that sense. I have to just value it at cost or NRV, which I expect to get when I am finally going to sell the asset. If there is no available price for this particular thing, and the company puts it as a particular, say, cost itself, saying that nothing is available, obviously the auditor may say that the information which are required to follow 105 is not available, and he will accordingly modify his report to that extent. And let me tell you, in most of the IBC cases, it's actually very easy to do an audit because in most cases, you can disclaim a lot of things because information is not available in that sense. So this is one case where if information is not there, you will disclaim that without information, I am not able to determine what is the price at which I record the asset which is held for sale. Now, having said that, you said that 2 months down the line after the year end, but before you signed off, there a transaction has already happened. Now, that clearly is an indication of a post balance sheet event, but which has an indication on what are the figures available on the balance sheet date. Now, that information can be considered to decide what is the realizable value of that asset, and that can be used to record that asset at a price on 31st March itself. Otherwise, I think you only look at this particular facts, how the standard is to be applied without getting into other nitty-gritties and complexities of how the IRP behaves, what is the IBC function. There are, of course, a lot of permissions which are required for selling the asset, especially from the lenders. Now, all that we consider them as procedural because once principally the IRP decides that I'm going ahead with the process, all the litigations which are there, all the lenders' permissions which are there, to me, they are more procedural, and the auditor can always say that this is recorded and draw an emphasis of matter to all these procedural items which are pending in that sense. Again, if it is very severe, he can convert that EOM into maybe a modification of the report that this is recorded. However, a lot of these uncertainties or complexities are still existing in that sense. But trust me, I consider IBC or IRP related accounts to be not very complex when it comes to issuing an audit report.
Any other one, Anand or Santosh? Anyone?
Yeah, no. So, Dayanivasji, see the question. So, the scenario of IBC, as Himanshu sir mentioned, it is much more broader than Ind AS, the requirements of Ind AS 105, because ideally your entire going concern assumption, your historical cost, concept may actually be challenged, and therefore you may have to go for a liquidation basis valuation. Now, the problem is in Ind AS 1, uh, you don't have any guidance with respect to if historical cost concept is not assumption is not there, then what do you do as an alternative? So liquidation basis accounting, but even for that you need to have some valuation, and as Himanshu sir rightly said, if you don't have any valuation, then the only option that you are left with is disclaimer and a lot of modification in the auditor's report.
Anything, Anand, from your side? An input?
Just one more thing. Just before you classify something as held for sale or discontinued operations, on that date, before the reclassification, the company is mandated to test for impairment. So first you do impairment test, arrive at the revised carrying value, and then you transfer it to held for sale or discontinued operations. And thereafter, like Himanshu bhai said, that you have to value it at lower of the carrying value or the NRV. So yeah, that's it.
So the sum total of this discussion is 2 points, right? One, I cannot change the law, which has to be straight, means accounting standards or Ind AS, which is there, has to be straightforward, complied with. And second, auditor has to use his common sense to draft and policy. Why I'm making this statement is most of the people, what they are doing is they're just copying, pasting for the previous year what has been happened. So certain events which are going to come in your lifetime when you're signing the financial statement, friends, it is very important that two aspects. One, a standard which is very clearly defined what procedure you need to follow. Number two, a role and responsibility and duty of a chartered accountant to qualify or make a statement in the financial statement lies in your hand. So these two things, if we are able to follow effectively, I think you are doing your right job. If not, then copy paste is actually going to give an impact because the information is not come. So I'm just making it same. So it is condition is same. But the circumstances in which every time it is moving forward, the transaction moving forward might be sometime when chairman gives me permission, I'll give the presentation on this particular case as a case study. What beautifully it has gone through. Literally, I had to design the entire roadmap of how it is moving. And based on that, the notes to accounts were getting drafted by the client because we insisted that in the notes to accounts, certain things have to come in a specific manner in compliance of standard. And the same thing, though it has been reported, that has to be reported by the auditor in a context of either emphasis paragraph or qualification where it is required. So the two things are different. Three things are different. One, compliance of standard. Number two, what the management has to do. Number three, what the auditor has to do. So this is just, I wanted to put it before you all people. Over to you, Chairman.
Yeah, thank you. मेरे को ऐसा लग रहा है कि पैनल डिस्कशन में 4 पैनलिस्ट है, मैं एक ही पूछ रहा हूँ क्वेश्चन. So Santosh bhai, a question to you. This is with respect to the FVTPL, fair value through P&L. So it was noted that in the fair value changes of investments designated as FVTPL were disclosed as a constituent of other income. So whether this disclosure is appropriate. And the second question with respect to FVTPL is that when financial assets are measured at FVTPL, are there any disclosure requirements regarding treatment of their interest income?
So Vishal bhai, the first question is with respect to presentation. Ideally, as per the requirements of Schedule 3, there is separate disclosure for fair value movements. So, and more so for example for a NBFC for that matter. So in NBFC, as per the Division 3 to Schedule 3, fair value movement is actually presented on face of the P&L rather than in any other income or other expense. So combining it with other income would be incorrect. As far as your question with respect to the inclusion of interest income in fair valuation is concerned. Now, what typically happens is, let's say if you are having a financial asset, which is a debt, financial asset in nature, because otherwise you will not have interest accruing on it. And then, so fair value, ideally then, whether as a policy you calculate it come interest or X interest. So for example, if let's say you are fair valuing an investment in a bond, okay, and then therefore, let's say at the year end, as of 31st of March, there is some embedded interest which has been accrued, which the payment of that is not yet due. So question is whether you combine it, so the accrual of that interest you include it in the fair valuation, or you say that no, that's an interest accrual, and even if it is not due based on an EIR, based on a accrual basis, I separately disclose it as a interest income, and I measure the asset without the interest, so X interest in that sense. So either which ways, you need to give a clear accounting policy in the financial statements as to what exactly your, what is your policy with respect to in such cases. This is an issue which is more pronounced for financial services, NBFCs, etc. That you need to have that disclosure, that policy, disclosed very clearly, articulated very clearly in the accounting policies.
Thanks for that detailed response, Santosh bhai. Coming to Himanshu bhai, sir, some questions we have for you, which are typically under the Companies Act now, because I know we have been bombarding with you with a lot of Ind AS 1 questions. So just some diversification now. What was observed that the directors had signed the financial statements without stating for and on behalf of the board of directors. Is it mandatory to write this statement?
It would be in that sense mandatory because how do directors sign financial statements? They are authorized by the resolution passed at the board of directors meeting that the accounts are authorized to be issued, and so people are authorized to sign the financial statements. Such a thing is only not required if the entire board is signing. If all the directors of the company are signing this report, then you may not need this, because then there is nothing to authorize because everyone is signing it. But typically you need only 2 directors to sign, plus maybe a CFO and the company secretary. And therefore, in terms of the resolution, they are authorized by the entire board that we authorize these 2 directors. They don't need to authorize CFO and CS because that comes by the law itself. But they will have to authorize any 2 directors to sign financial statement, and that is why they have to write for and on behalf of the board of directors.
Right. So unless the whole board signs, it is mandatory to have this phrase that is to be mentioned. Continuing with the signing part, Himanshu bhai, can directors or auditors attend the meeting and sign at different cities or countries? And should such different places be mentioned in the financial statements or the auditor's report? And also whether the directors or auditors can sign at different dates?
So first, let us go on the dates. Okay, let's go on the place. On the place, typically the auditor has to sign the financial statements at his base location. So if a base location, say my base location is Mumbai, so typically most of the financial statements I sign would be at a base location of Mumbai. Now there is a possibility that the meeting has happened online and the directors are physically all present in Delhi and they sign the financial statements in Delhi, but I am sitting in Bombay in my office attending the meeting. And after that meeting, since everything is approved, we sign. So the place would be put as Delhi for the directors who sign. But when I sign, it will be placed, the place would be put as Bombay. Now it is possible that in some cases, I may also travel to the same location where the meeting is held, in which case I will put the location where I am present in that sense. So the directors will put Delhi, I will also put Delhi. A third possibility, I am in Baroda, the meeting is in Delhi. My base location is Bombay. So then I will have to write that I am signing in Baroda, but writing there as a Camp Baroda because I'm camping currently at Baroda, though neither it is my base nor it is the place of the meeting in that sense. So all these three possibilities are possible. And even within directors, if some director is present at some other place and he is signing this, he can also put a different place in that sense. Okay.
And
Coming
Himanshu, sorry, before we go to dates, what happens if definitely very difficult for the auditors to travel abroad during this season. Otherwise, I know we would have all loved in this heat to be somewhere in Switzerland or somewhere. But it's very easy for the directors to keep traveling. And in such case, then what would it be? So we'll have to write the city and the country from where it is being attended, and how would the signing take place,
So
sir?
say the directors have held the meeting in London, but you are still sitting in Bombay and attending the meeting. They will sign with a place of London, UK, and you will still sign with a place of Mumbai and India. So that same
Okay.
logic really applies in that sense.
Fine.
Coming to the date aspect, clearly the directors will have to sign first and then the auditor signs. It is never the other way around. So the auditor's date will always be the same date or a date later than the date when the directors have signed. So it cannot precede the date when the directors have signed. Otherwise, clearly you are not waiting for the accounts to be adopted, but you are signing, which is a grave mistake which you have committed in the Companies Act. So it is possible that, say, for instance, the directors are in United States, they sign on a particular date. You sign it on the next day because when the meeting was held, it was already a different date in India in that sense, with maybe a 10-hour difference or something. So they sign on, say, 17th April. You actually sign on 18th April. That is possible. Though the meeting happened simultaneously at the same time. But a more difficult possibility is that the director signs, say, on 17th. You have attended the meeting, but you are not able to sign today. You sign maybe after 1 or 2 days because all directors have not come together and they have not signed or something. In case you then put a date of say 18th or 19th for signing and the meeting is not in that sense simultaneous and the signing is not simultaneous, you will have to consider whether any events have happened between the director signing and your signing. If there is an event which has happened between their signing and your signing, the effect of that may need to be taken in the financial statements. So that is why it is always better for auditor to sign as soon as possible after the accounts are adopted, because otherwise he has to get into some extra procedures for verifying whether any material events have happened between the intervening dates which are there.
Right. And like you mentioned, especially again going back to that international scenario, that like you said that, where the meeting and all the directors are in London, and as auditors, we have attended from Mumbai. And typically then, when they sign the financials, if it is not digitally signed, but physically signed, and for the financials to come to India, it might take a week or so. And therefore, what you mentioned, that we have to mention the date when we are actually signing, which would be after a week, and also document whatever, whether there are any events that have occurred between the date of signing by the directors and date of signing by the auditors.
However, that is now minimized because with these digital signatures which are accepted, normally we would not like to wait that much. We would then try and sign the financial statements digitally. So it happens almost on the same day or at least on the next day. Because the more the gap, more difficult or strenuous the procedures can become.
True. Correct. Thank you, Himanshu bhai. Coming to Anand bhai. So the question for you is, are letters of comfort and corporate guarantees, are they financial guarantees? How should they be recognized?
I think, sir, there's a ICI FAQ or something issued on this, wherein it says that it is very critical to understand the language of that document. You may call it letter of comfort, you may call it, whatever different names, letter of support, There are various names which companies give to such documents, but it is important to understand the language. If the language is of the nature of guarantee or assurance which you are giving to the bank that if the borrower does not pay, then you will step into that position and pay to the bank, then it becomes a financial guarantee, whether the nomenclature is that or not. So the point is, don't go by the nomenclature, go by the wordings, go by the intention, go by the message that you're conveying by that letter or through that letter to the bank. That is more critical. The substance of that letter is critical. If the nature is of giving that assurance or giving that guarantee, then it is a financial guarantee. Secondly, many companies disclose these financial guarantees as contingent liability. Under Ind AS, these are not contingent liabilities anymore. All financial guarantees become financial liabilities, which has to be recorded on the balance sheet. Now, when you record these financial guarantees on the balance sheet, you have to fair value them. And in terms of fair value, you also have to do ECL computation. So normally ECL we do for financial assets, but this is a financial liability where in terms of fair value, you do ECL. So basically you compute what would be the probability of the borrower defaulting and the liability falling upon you, and that liability needs to come onto the balance sheet as a liability. So yes, back to you, sir.
So I'll just add here, Anand. Recently, in the last month, no, there has been a tribunal decision in the context of income tax that any letter of comfort is also an international transaction which is covered under transfer pricing. Now, that is something which in the past was never considered as an international transaction because only guarantees were covered. But even a letter of comfort is now covered as an international transaction, which actually adds more credibility to what you say, that a letter of comfort, whatever wording it is there, it can still become a guarantee in that sense. Of course, when you said that I will need to account for it, yes, that's right. But some companies do treat this letters of comfort or financial guarantees in the nature of insurance. And they follow this Ind AS 104 in that sense, in which case entirely different
Correct.
treatment comes up then.
I think
Correct. I agree, sir.
very interesting thought. And sometime it is, Vishal bhai, that, the letter of comfort, when you actually determine and evaluate a liability, that means the credibility of that organization also is going up. That is something which we need to see how it has been really appreciated, respected, that, letter of comfort also carries a value in itself. It is something which we need to really appreciate from an Ind AS point of view. Though might be there are different people following different thought process, that is a different part. But yes, if you see from a intangible value, it is having some relevance to treat this in a true sense. Friends, let me just tell you one thing, just because we are concluding and we are going to go, we'll be left with 3-4 questions. So I thought it is important before we forget that, we have a Twitter handle of FRRB. Request you all people to kindly follow the Twitter handle. In that particularly exclusive post, very small snippets are being shared, which is called Do You Know series. So might be sometime it looks very funny, but those things actually give you a tinkling in mind when certain critical situation comes. See, anytime a situation might be looking simple, but at a time when you have to apply a basic standard, at that point in time we get a question that, "Arey, ye hona tha ya nahi hona tha, ya karna tha ya nahi karna tha." So what we request you is, might be you can just pin it up on the whoever. I think today we have close to around 700, 800, which started with, I think that number would have gone up by now. We don't have the statistics as such. But whoever is actually coming forward, our request is, because the credibility of a chartered accountant stands on the reporting framework, what we are signing is a value which is actually giving the value given to the profession at large. A smallest transaction, if it is presented in a beautiful manner, I think we have to romance with the numbers only. We don't have anything left. Or maximum, if you want, you can romance with words, but not the way we discussed in a little past. So my request to you all people is that part of uh, walking through with the Twitter handle will actually give you a lot of input. Tell your articles, tell your students, tell your friends to follow that on a continuous basis. That will be an interesting part. Now coming back to संतोष भाई, मुंह पलटा के मत बैठो यार हमसे, तो आप हमारी क्वेश्चन सुन लो. So the question goes is basically, it was noted that a change in business model has been made by the company. Consequently, financial instruments which were otherwise valued at amortized cost were now valued at fair value through OCI, and loss arising out of reclassification of financial assets has been charged to statement of profit and loss account. Right? However, the disclosure with regards to this reclassification have not been provided in the financial statements. Request you to share disclosure that are required in such circumstances.
So Dayanivasji, this is a significant event. So typically what happens is, and I would imagine this is the scenario that you are mentioning, is that of a NBFC, which is, having a loan portfolio which was earlier, carried at amortized cost. Now, firstly, why is business model important? Just to kind of refresh for the benefit of the audience, is that under Ind AS 109, if I have a debt portfolio, a loan portfolio, or preference shares, it can be any debt investments. One of the preconditions to carry it at amortized cost is that the business model should be such that I am holding it till the contractual maturity. That is one of the conditions. That is one of the preconditions to classify it as amortized cost measurement. The standard acknowledges the fact that business models can change. For example, on top of my mind, I recollect that I think it was last year or the year before the last, where one of the leading NBFC, they said that we are changing the business model for their wholesale loan portfolio because of a specific board of directors strategy to focus more on the retail loans. So therefore, one fine quarter, they entirely changed the business model from amortized cost to FVOCI. FVOCI is what? You are actually saying that you have a mixed model, which means that certain portion of your overall portfolio you will hold till the maturity, but certain portion, whenever the opportunity presents, you will sell. So therefore, you're having a mixed model. In that case, you follow an FVOCI, or an FVPL is when you are actually, the business model is to sell. Sell in the context of Indian, in the RBI landscape would be that you would be having a business model to do it as a direct assignment or some kind of a securitization to for the loan portfolio. So that is a scenario when this case would arise, and in that case, it's a significant event that would warrant a separate disclosure of the gain, the day one gain on the date of reclassification, and a fairly elaborate note in the notes to accounts. So therefore, that would be, since it's a change in business model, it would have been triggered by a change in the strategy or maybe the liquidity requirements of the company, and therefore it would certainly warrant a separate disclosure. And even the day one fair value gain or loss that would arise, in my experience, it would be normally be a loss in most of the cases. It would have to be classified, it would have to be presented in a separate line item as per the 107 requirements. So it has to be certainly separately disclosed.
Any other suggestions or points from Himanshu, Bhai, or Anand?
No, this needs a fairly elaborate disclosure, any change in such business model classification. And again, this is something which you cannot switch from year to year. You cannot keep on changing your model year to year. Once you do a change, it has to be for good in that sense. Otherwise, the change is not considered as a correct change in that sense.
Yeah, I agree. This should not be considered as PNL management. This should be taken as
Yeah,
rare scenario
yeah.
and should have really some context or some real good justification behind such change.
Great. I think very well taken. And let me just ask one more question to Santosh again. That is with regards to that. Now we'll go because this last 3 hours means 15 minutes left. So let us go reverse way. And Santosh, for you, it is on expected credit loss, right? And this is very interesting part, though again very simple, but again people have their own interpretations in their own way. So it was noted that the expected credit loss has not been recognized for doubtful trade receivable. Can you guide on expected credit loss, its recognition and measurement criterias? Many times companies are in dilemma whether in certain cases of doubtful receivables, they can provide for 100% when ECL is recognized.
Yeah, so Dayanivasji, you said last 3 hours, expected credit loss would warrant, a full test match. It's not just about the last 3 hours, right? So, just to be, very short answer to that is ECL. So, the trade receivables have to be tested based on a simplified model that ECL, Ind AS 109 gives. Now, although the word is simplified, it's not as simple as it sounds because it has to be, so ECL loss provision has to be also estimated on a fairly scientific basis, even if it's a non-financial services company, even if it's a simplified model. So ideally, technically speaking, you would have to establish what is the flow rate of your trade receivables. So for example, to put it simply, if I have a portfolio of customer, balances, ideally, I'll have to look back at, let's say, last 3 or 4 or 5 years, whatever, business cycle I would have. Look at it from a DPD perspective. What is the past due records that I have, and identify the behavior of my customers. So, and then based on that, I would extrapolate, and I mean, there can be a kind of an Excel spreadsheet around this as to what is the normal behavior, the realization behavior of my trade receivables portfolio. Having done that, okay, having identified, having calculated the percentages for my various, customers, and how would I do that? I would do that based on time buckets. So 0 to 30 days, not due, 30 to 60 days, so on and so forth. And also I'll need to segregate it based on my businesses. So for example, if I'm a conglomerate, let's say, and if I have various business verticals, I'll need to identify it for each business vertical that I have. Now, having estimated the flow rate of my customers' behavior, the next step is that I look at the balance sheet date, position of my customers, again, based on the time buckets, and I extrapolate it based on my historical trend of my customers. To this, I also adjust the forward-looking kind of a thing. So since it's a simplified approach, I do not care about, whether there is a SICR or a significant, increase in the credit risk. I do not worry about, whether there is a credit, impairment. I have to do a lifetime provisioning of these financial assets. I also built in some kind of a forward-looking thing. So for example, let's say in the COVID scenario, if my historical trend would have been that on an average, my customer takes, let's say, 60 days beyond the due dates to pay off my dues. In a COVID scenario, or let's say if based on my forward-looking estimates, if the customer, the financial condition in which the entire ecosystem of the customer is a little difficult for next, let's say, 1 year or 3 months or whatever, I need to build up that extra cushion for forward-looking adjustment also. So this is the simplified ECL approach. It may not sound very simplified, but that is what the standard gives. I think one of the question was, there was one more part of the question which I forgot. Sorry, sir, you are on mute.
100%, Rama.
No, it is not
100%
that 100%. So you need to have, as I said, a matrix that you need to build. So you need not necessarily provide 100% unless, of course, you are expecting nothing to be realized. You need to have, based on the aging analysis, a kind of a matrix which the management should, the board or some senior person in the management should approve. And lastly, if you have disclosed in the accounting policy that you are following this, whatever I said as a matrix, then make sure that you follow it, because I think one of the NFRA inspection was that you have an accounting policy for provision matrix, but the company, as a matter of fact, did not have any matrix. So you should not be guilty of not doing what you have written. So
Yeah, now totally है ना, वो एक ओवर का मैच नहीं है ये, तुम चलाते गए, but इसका एक simple 2020 आंसर दे देता हूँ. Get a letter from the management saying that this amount will be recovered in shortest period of time. और आज के तारीख में what is happening is not only the company which you audit, primarily the customer from where you are actually getting, the client is going and getting a letter saying that you don't provide any expected credit loss because I am going to recover this money and this is going to be, I am promising that I am willing to pay that money. So that is also a simple answer for this entire discussion of matrix.
Management representation letter cannot be the sole, thing.
Not management representation, Santosh. It is basically they are actually getting the letters from the buyers who are actually doing it. That shortly we'll be paying that money.
No,
So
the problem
don't
is
make
in
any
Indes. I agree. I understood what you're saying. In Indes, basically, there is also a concept of time value of money. So if the trade receivable has been outstanding for a long time, beyond the due date, and even if the parties, willing and it's in a good financial condition, I cannot take a thing that, there is no chance of default, because time value of money has to be also built in this whole thing.
Himanshu bhai, last question and then.
Sorry, if I may add just one point to what
Anand
Santosh said. So there is some confusion caused by Schedule 3 also, because Schedule 3 requires a disclosure for trade receivables into good, doubtful, and credit impaired. Now that is an enabler for companies who are following general method of ECL if there is significant financing component or something else. For companies who are following simplified method of accounting for ECL, they cannot classify trade receivables into good, doubtful, and credit impaired because you're following a matrix concept. So there also companies need to be, very clear into what method they're following. The presentation should be accordingly, and they should not simply do something for credit Schedule 3. Schedule 3 is only an enabler there. They should change the presentation according to the method they are following.
See, I think the substance over form, or might be why I asked that question or created a hypothetical situation, Santosh bhai and Anand bhai, is primarily there is no exception for certain things. In a sense, like, if we create a hypothetical thoughts, my point is basically apart from Schedule 3 or might be standard compliance, what is important is substance over form. And that need to be really looked into, and that cannot be, just taken as the go. Over to you, Vishal.
Yeah. So one question to Himanshu bhai, and then we will have a quick fire in reverse order with Anand, Santosh, and then last word from Himanshu bhai about for the participants in this audit season when they for the preparers as well as the auditors, what would be their I would say closing words. But one last question to Himanshu bhai on Schedule 3. And Himanshu bhai, this is typically for companies which are into trading as well as manufacturing. So what was observed that in the statement of P&L, the cost of material consumed, it had been clubbed under purchase of stock in trade and raw material. and changes in inventories of finished goods and stock in trade, though the company is engaged in business of trading and has its own manufacturing facility. So can you just highlight about, especially when the company is into trading as well as manufacturing, that the cost of materials consumed, the inventories and movement, how it should be classified into the different line items that have been prescribed under the Schedule 3?
Right. So, if there is a company which is having both activities which are material, say manufacturing activities as well as trading activities, there has to be two specific discrete disclosures on that. And for manufacturing, you will have opening stock, you will have cost of goods sold, which is in turn derived from what is your purchases and other expenses which are added, less closing stock in that sense. So that is clearly there, and there is a opening closing difference of finished goods and work in process. That is for manufacturing, which is very clear. So I have cost of goods sold, which is opening plus purchases plus expenses minus closing. Opening minus closing for finished goods and work in progress. In case I also have trading activities, I have to write purchases trading separately. I have to write sales trading separately, and I have to give a difference of opening and closing stock in trade. Because there I have got something like a stock in trade because I am doing trading. So both these things will have to come one after the another in the profit and loss account. You can write for manufacturing, this is what I am giving. For trading, this is what I am giving. You cannot mix up the two things. Otherwise, you are not conveying any information in the financial statements. I believe people do get confused when one of the items is not material. So you are primarily a manufacturing setup, but you also do some trading. In which case, you may not write everything in that detailed manner because it may not be material. You may include everything in cost of goods sold with the added disclosure there that this also includes traded items rupees so much and sales include trading rupees so much if it is not material. But if it is material, both the disclosures will have to go separately one after the other in your statement of profit and loss.
Yeah, thank you, Himanshu. I think so that was pretty crisp and clear about what the companies have to follow for the disclosure requirements relating to the purchase, or I would say consumption, trading as well as manufacturing. So we have the last 5 minutes, which we would utilize for the, I would say, final maybe 2 minutes each on for the participants, for the preparers, auditors. Your take. So, like we discussed a lot of findings of the FRRB. We had a lot of other questions also. In fact, today I've just received a message that we had additional 41 questions from the audience. So, I feel that we have a very good audience. So first, Anand bhai, your words on the sign off for these 2 days webinar.
Sir, firstly, I would say that the importance of this seminar comes from the fact that chairman, vice chairman, sir, both have spent 4 continuous hours and not just introduced us and you know so normally the seminars happen this way, but you have spent every minute of this 4 hours with us, made it as interesting as possible, and that shows the importance of this topic and also the timing at which this this session is happening, which is in April. So my 2 bits to people here would be that get more serious about financial statements because the regulators are getting more and more serious, and the penalties or the implications are getting more and more serious. Not just about the presentation of financial statements, the disclosures, but also about your documentation, about how did you arrive at such conclusions, the judgments, the assumptions, the auditing, everything about it. So I would like to thank for such a wonderful opportunity that I got. Very interesting questions, very topical questions. So thank you so much, sir. Thank you so much.
Thank you, Anand bhai. Santosh bhai, over to you.
No, I would like to echo what Anand mentioned. I think as a preparer plus auditor community, I think we cannot estimate the requirements of the financial reporting under accounting standards and Schedule 3 and all that. Because as Anand mentioned, regulators, NFRA, ROC, FRRB, etc., we have a lot of people looking at our disclosures, our accounting through a microscopic lens. So it cannot be ignored anymore. Accounting is no more a soft, kind of a regulation. And as Anand said, there is significant penalties that are being levied on the auditors, on the finance directors, on the CFOs, etc. So yeah, that's about it. And of course, thank you for giving me the opportunity. So yeah.
Thank you so much, Santosh Bhai. And last but not the least, I think the senior most amongst all of us, the most experienced, Himanshu Bhai, your, I would say, advice to the participants and all of us.
Okay, so let me divide this into two parts. One is for the preparers and then for the auditors. For the preparers, I would like to say that whenever you are writing a particular policy, please make sure you follow that policy. And if you are following a particular policy, make sure you write that policy. So that is for the preparers. Follow the policy which you are writing or write the policy which you are following. Both have to be done. And for the auditors, I have a very simple thing. Please read what you are going to sign. Because a lot of times we believe that a lot of things are not read, including the drafting of the report, the notes which are there. So for the auditors, please spend time in reading what you are going to finally sign. So I think this should be more than enough to, do your job in a better way in that sense. All right. So thank you for this.
Great. No, thanks a lot, Himanshu Bhai, and thanks to all of you. And before we finally sign off, I would request Daya Bhai. Next time onwards, I would request Santosh, please don't call him Daya Nivas. It looks too long and too formal, so we call him Daya Bhai only. So, so please, sir, your final words and vote of thanks.
Thank you, Chairman. And it is indeed, I have to actually search for my words, though I was just trying to make it light during the course of our discussion. Thank you all the three panelists. Trust me, it might be 10 times I would have told Chairman that, you have picked up the right set of people, because it was so interesting, and the points which were being pointed out, certain questions we share. Friends on the audience who are there, we just share certain questions with the speaker generally. But today, in this particular 2 days, particularly these 2 days, we have ensured that with that particular set of questions, we actually add what we have gone through. When chairman or vice chairman, when we are asking certain questions, we are asking with our experience also. And fortunately, the kind of exposure we get in the entire process, not only as being a council member, sometime when you are actually sitting and signing as auditor. So the third leg which Himanshu Bhai missed out from a preparer or auditor, but also as a regulator when we look at. Sometimes knowing more is also difficult. And we are in that state of situation. Correct, Himanshu Bhai? As a regulator, we, as an institute, as a regulator, as a council member, when we are sitting, we actually get a little worried how it is actually happening. And most of the time, which we have noted is that people have not done it intentionally. It is basically a gap which is there. Somewhere a platform which is in form of a Twitter handle, which is there for all you people, reach out to us. Reach out to us individually, reach out to us on the Twitter, or you reach out to us by a mail. The only fact which we would like to tell you before all you guys is 75 years of standing of ICAI is not small. I think many institutes which are there across the world, and today to be called as the world's largest accounting body, and we actually have determined so many new things, whether it is forensic audit, sustainability standard audits, sustainability standards, or you talk about the UDIN, you talk about, coming out with the carve-outs in the Indias, ensuring that the compliance are going to the right direction. Then most importantly, as an auditor who is signing the financial statements, which is actually complying with various laws and regulations, is actually becoming task or might be a responsibility which is being placed on each one of us is in a true sense, seen from, we should see from a positive perspective. And this session, which was being planned, architected by the chairman, rather I compliment him. I was actually not, able to visualize how this even 2 days are going to go. But really compliments to him that, he actually compiled all those things. And we ensured, Anand Bhai, you specifically thanked both of us that we have sat for 4 hours. It is not matter of 4 hours. Let me tell you, it is my 6th year in council, and our interest is members' interest, society interest, regulators' interest. Same is the case with Vishal Bhai, where he actually has come forward to think from a perspective that, when it is easy to tell after doing it, right? But it is important that we actually forewarn, or might be we keep ourselves well informed about the approach which we need to follow for the closure of financial statements. You three has actually made this entire thought run to the last mile and ensure that the chairman's thought is actually been put before the members at large. Thanks to you all three at one go. And thanks to the chairman, the office, which is actually always behind the screen, right? The secretary, the entire group of people who are really running FRRB in a true sense. We are thankful to them. We are thankful to the institute employees who are sitting in the institute for only both of us, because today being a holiday and everyone is gone, there are only 2 people or 3 people sitting. So thanks to those people also on a larger platform. And friends, we look forward for more and more interaction in time to come. And let me tell you one thing, it is not going to stop here. It is going to be more interesting in time to come. Might be we'll go standard by standard, or at one go, we will do a marathon exercise where we'll do a complete recording of a financial statement from the top to the bottom, how it is actually going to look into. Every aspect can be run. So we will think about the conceptualization, which is left to the chairman. But yes, happy Ram Navami to all. And Surya Tilak was actually put to Lord Ram Bhagwan. And we are very happy that, with that Surya Tilak and these 2 days of discussion, deliberation, the energy, the aura, the kind of thought process which our members are going to go through, because a lot of people are writing messages to us saying that it is one of the most interesting discussions and deliberations. We really don't know. Thanks to those people who are appreciating. Thanks to those people who are not even appreciating also, or might be they are worried to appreciate. But yes, we'll come back again very soon with the new series. Thank you very much. Thank you all.
Thank you very much. Thank
so
you.
much. Thank you.
And have a nice evening. Thank you.
Thank you.
Thank you.